Hi, folks, and welcome to the Meaningful Money Podcast. This is Season 17, Episode 4. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Hello, great to have you with me once again. Today I want to talk about investing in retirement, which is a big subject. It's a subject I dealt with a couple of times, in part at least, in the last season. So there are links to those shows in the show notes for today. But I wanted to sort of deal with it slightly differently this time. So I've called in somebody who should know what they're talking about, because they have helped build a system to help retired investors build a sustainable portfolio for life. And the company is my sponsors, 7 Investment Management. So my guest today has helped 7IM sort of provide a future-proof managed investment system for their clients. So I think we're going to learn a thing or two from chatting to him. So after the conversation, as ever, I'll look at the reviews that have been left and announce what we're going to be talking about next week. But given that I've mentioned them already, I also to put in the proper bit, which is to thank 7IM for their continued sponsorship here on Meaningful Money, which has been going on for 9.5 years now, which is just insane. So I'm super grateful to them for helping me stay on the air. Do check out what they're up to, 7im.co.uk, number 7im.co.uk. Definitely go check them out. So my guest today is Matthew Yates of 7IM, and I'm going to be talking with Matthew about their retirement income service, which you may hear me and Matthew refer to as RIS, Retirement Income Service. 7IM created the RIS to fill a need for retired investors looking for a portfolio which stands the best possible chance of outliving them. It's based on some pretty detailed research, I can tell you, and I think we can draw some lessons from it, building our own retirement portfolios. So remember, notes and links from today's show, they're at the show notes. It's the only link you need to remember, meaningfulmoney.tv/RP4 for retirement planning, episode 4, meaningfulmoney.tv/RP4. Here's my conversation with Matthew Yates. Well, it's my pleasure to welcome Matthew Yates, who's a Senior Investment Manager at 7 Investment Management. That's obviously a name that you've heard many times. They've been sponsoring Meaningful Money forever. But Matthew, great to have you on the Meaningful Money podcast. Thanks for joining me. Where are you speaking to me from?
Coming from Clapham in London. A sunny Clapham in London.
Yeah, exactly. Too nice a day to be stuck working from home. You may gather I'm slightly unshaven. I've been in the garden all day. I'm actually on a week off this week, so I'm not scrubbed up as I would usually be. But look, thank you for joining me. Can you just give us a quick bio, Matthew? So who you are, what you do, and how you got to where you are here at 7IM?
Yeah, sure. So at 7, I work on the investment team, as you could probably guess earlier. But before that, and actually when I first moved to 7, I worked on the risk team. And before 7, I worked in quant research at another investment firm. So between risk and kind of quantitative analysis, like my work tends to be exactly that, quantitative in nature. Now within 7 itself, a lot of my time has been spent really leading our research efforts into the retirement space. So how can we approach and think about some of the problems that people in retirement face when they're trying to think about how to structure investments, but doing it from, as I said, kind of a kind of quantitative scientific angle.
Good. So you're exactly the right person to speak to, which is marvelous. It's almost like that was intentional. But just sort of before we dig into the mechanics of how 7IM's retirement income service is structured, does investing in retirement differ fundamentally from investing in accumulation? And if so, how does it differ?
Yeah, I think it does. And I think especially when we're considering the shape and the, let's call it the path that many investments could take, there's one key distinction. It's that key distinction, I suppose, that sits at the core of, any advice that we give people is try to think about the long term. Mm-hmm. Now, when you're investing in retirement, essentially what you're going to be doing is taking income over the short term, most likely. When you're building up that retirement pot before you've actually kind of got to that day when you're trying to take money out, you have the benefit, I suppose, of being able to take the long term, because you don't have to go with your month to, take your salary or kind of whatever it may be from that pension pot. So that for me is the key difference. And that has a difference from two angles. I think one is, as I said, my angle, the scientific angle. It means the shape or the drawdowns or the downturns in markets can be more meaningful because you're potentially drawing money out at the same time, crystallizing losses, it would say, not giving them time to recover. Sure. And the second, which is just as important, I think, is for the end investor, for the end person that's essentially taking that money through time, trying to live off that retirement pot. The behavioral nuances of it become, that much more difficult, I think. It can become, much scarier. If retirement's 10 years away and you have a drawdown, it's like, okay, well, in the back of my mind, at least I've got a bit of time to allow things to recover. If it's, live and happening and you can't really go back to work, what do you do then? So I think from a scientific angle, you have this impact of withdrawing money at the same time as market falls, locking in losses. And from the behavioral client side, it can become really, it can become challenging. So we need to have ways to make them feel comfortable, even if you have those drawdowns, even if we're drawing money out.
Super important. That's going to be my next question, was just to ask specifically about attitudes and behavior, particularly towards volatility, because I've got a sort of one of those career-defining stories where I had a client who had run a business, built a very successful business, had always been in control, and then when he sold it and invested some of the money, it was clear that the answers he gave to the risk questionnaires, which are barely fit for purpose, a lot of them anyway, but we definitely didn't do a good enough job about ascertaining how he would behave, because he hated not being in control. So I just wonder whether that's your experience, whether you see a marked difference between accumulating investors and decumulating ones when it comes to volatility and risk and concern over that sort of stuff.
No, I think there is an element of that. There's a lot of psychology kind of work, a lot of academic work that would suggest that actually people's, really inherent behavioral traits through time are going to be pretty constant. If you're a risk taker and you like skydiving before you retire, you're going to be a risk taker and you like skydiving when you retire, and your approach to volatility comes in the same manner. But I think in reality, we know there is a difference. And I think one of the things that can lead to that is, for so many people, actually retirement is the first time that they may have a meaningful amount of money to invest. But for many people, it's that point of retirement, maybe, money coming out of a DB scheme, or kind of the release of this thing that seemed a little bit distant before in a defined contribution scheme. And suddenly that money is there for them to make investment decisions about. It's not the company they work for making those decisions for them. So just that change and just that shift to a big or large amount of people that are investing in retirement can be quite significant. But also I think it goes to that, that element before, that there's, because things suddenly seem short-term about providing that income, etc., it can worry people a little bit more. And so I think it's natural for that to be the case, even if some psychology studies, etc., would tell us that those preferences should be constant through time. And for many, it will just be the first time they have a more meaningful amount of money to invest. And so I think for them, anything that's new will inherently be scary straight away. But, like you said there, the big thing and the big drawdown or the big event or the big volatility doesn't matter unless it causes people to do things that do matter.
Yeah,
and
exactly.
the big stress test for a financial plan, I always like to say, this is not the global financial crisis. It's not what happened in March this year. It's that happening and people pulling money out.
For sure.
That's the stress test. That's the volatility that matters. And so everything that we're doing when we're thinking about investing for retirement has to be about stopping people do that. And it has to be about making people feel comfortable.
Perfect answer. That's absolutely right. There's always a difference between sort of academic studies and actual real life on the ground experience, because, we're humans, right? So having something called what the regulator likes to call a centralized retirement proposition, that's a sort of a term used usually for advice practices. What is the way that we advise clients to invest in retirement? That's such a hot topic. Seems to have been for the last 18 months, 2 years or so. So 7IM have their retirement income service. So what was the itch that you were trying to scratch with that? What was the thought process? Did somebody, was it a sort of a brainstorming board meeting one day, or what? How did that come about?
It came from a couple of different places. So I think, as I alluded to earlier, I'd written some white papers that we've been publishing on kind of retiring, investment for retirement. And they were, it's a bit like you said before, the academic and the real life. And so we had this body of work that we were doing internally, but then we also had ourselves, hundreds, thousands of clients across our business that we were running in retirement money for. And we had, pretty good outcomes across all of those. But what we wanted to get to, I think, which is, what you referenced there with this idea of a centralized retirement proposition, is just a consistent framework and a consistent format for approaching those same problems. We wanted to make sure that all clients were kind of really, although their needs and their wants are going to be extremely bespoke, and that's what financial planners are going to work with those clients to establish, we wanted to make sure that for a consistent, income aspiration or for a consistent amount of time that needs to last, that we were following a consistent approach. And so for us, it came from solving that internal problem. It came from saying, we've got lots of academic type research in here that we've developed over many years. We've got lots of models that we've developed over many years. How can we allow people access to them? How can we allow advisors working with clients access to those to make sure that we're getting good, consistent outcomes? And so it came from solving that internal problem, and it came from trying to tie up some academic research we'd done to the real world usage of those, I suppose.
Okay. So if you were to explain what RIS, the Retirement Income Service, is trying to achieve to a customer, then how would you sort of succinctly put that? Because obviously you would never talk to a customer about quant and volatility to that extent. I'm just wondering how you would describe what RIS is trying to achieve before we get into the mechanics of how you're doing it.
Yeah, so I would say RES is the way we go about providing people income in retirement. So by that, I mean, it's the way we structure a portfolio differently, not just for meeting a long-term savings goal, but for meeting a long-term goal that is providing income through time. And if you look at the options are out there, that there's many, but we think we approach it in a very kind of specific way. So if a client comes to us with an income need in retirement, the RAS is the framework we use to take off the shelf almost a process that we then give to them to commit to achieving that goal through time.
Perfect. Okay, so let's talk turkey then. The mechanics. How does it actually work? How is it structured? So somebody comes to you with X amount of money. You can put a figure on it if you want, and they want so much per year. What's the process from that point of setting things up for them?
Yeah, so I think the way I like to think about it is the way that I described earlier why investing in retirement is a bit different. And it's because, as well as if you imagine the process, if you were just saving for a long-term goal, for example, you might go through, as you said earlier, like a risk profiling exercise. You might have this risk profile and you might go to a specific firm and say, okay, this firm invest in a certain way that I like. What's my risk profile? Okay, this matches to their multi-asset fund. That's what's going to help me kind of get to my goal. At the first stage, what we do is take in a little bit more information than that. So we take in just an income requirement, a risk profile, and the amount of time it needs to last. Okay. And then off the shelf, we would then have a way to approach that. And that will essentially be something similar to picking off the shelf just a single fund or a single model portfolio or a single portfolio for that client. But what we'll actually do is combine several of them in a very specific way. So what that means essentially is I think, or three key steps. The first is taking in that income requirement, taking in how long it needs to last, and taking in how much risk they're willing to take, and playing back just succinctly in a dial. We have this dial essentially that says, okay, if you want to take 3% a year and you have a balanced risk profile to last 25 years, that means that you're pretty on track. It may say otherwise, but that first initial guide. And then the second thing we do, rather than just taking all of the money that somebody would give us and investing it in one product, I suppose, what we do is split it up into short, medium, and long-term pots, essentially. So we have some cash on deposit to just provide that income through time. We have an amount of money that's there with a slightly kind of lower risk there. Again, there's a little bit of a buffer, and I'll talk a bit more about that buffer in a second. And then we have some longer term assets as well, some longer term growth assets. So we've taken in the income requirement, we've taken in how much risk people feel comfortable with. We've played back how likely they are to reach that goal. What we've also then done is, rather than give them just one product, we've given them this mix, which in giving them that mix means that if we have those short-term periods of volatility that we talked about earlier, we don't necessarily have to be drawing money out at the same time, because we have that buffer of the cash pot that I talked about before that's there to pay out that income through time. And we have that lower risk pot as well. And importantly, the way that last step works, which is the third angle, is we have just a very strict set of rules about how that portfolio is going to be rebalanced through time to pay that income. So we play back how likely those goals are to be successful as a default. We mix things in a set of buckets that provide a buffer that mean you don't have to eat into your investments, even if markets go down in the short term. And then we have a really kind of defined set of rules that we follow through time in how that cash is going to be created, even if markets go down for a very long time.
Cool. That I think we need to drill into a little bit, if you're willing, because many of my listeners have read Beyond the 4% Rule by Abraham Okusanya, who's obviously one of the sort of foremost people in this country who talks about this, I think, and he would talk particularly when it comes to rebalancing. So, firstly, actually, let me just back up a little bit. How much cash generally would you suggest that people keep? Is there a same for everybody, or is it a moving feast? So
we go for 2 years worth of income in cash, and that's a really interesting question, because that's actually a little bit like the 4% rule, or you see lots of numbers being banded around, almost kind of rules of thumb, and just in the way that I think there's no single income level. So there's no such thing as a sustainable draw rate. There's no such thing as 4% is right and 3% is wrong. Sure. The answer is it depends, and it depends on all the other assumptions. Yeah. There's no such thing as well as a perfect amount of cash to hold in reserve in that short-term pot. So anybody that says they found the perfect amount of cash to hold in portfolios is also being disingenuous to the problem. What we needed to come up with was an amount that we think provides a reasonable amount of buffer. And unless you hold 100% in cash, you're never going to be 100% certain that you're going to never have to kind of eat into your investment amount. But also makes it possible to do the other part of the equation, which for us is, importantly, when people talk about bucketing and putting cash in reserve. Imagine if you just had your invested portfolio and all you did was go and put a little bit of cash to provide a buffer against short-term volatility to give you that income through time. All of the things equal, that's going to reduce the amount that you have invested, and so reduce your investment return. Yeah, that's providing what we call a cash drag in portfolios. Importantly, what we want to do and what we do with the way that we construct our bucketing is that we hold an amount in cash, 2 years, as we said, but we also hold an amount in the higher risk pots that exactly offsets that amount of cash.
Okay.
And the impact of that is that we keep the overall risk of the profile the same. So when I said why 2 years, 2 years for us has a high 90% probability, and this is me going to my maths brain again, of covering you for drawdowns that might happen. But it also makes that balancing act possible. As you start to get up to 3-4 years, we found that became really difficult. So 2 years for us was the thing that, in the framework that we were operating, makes that balancing act of the buckets possible, whilst also providing what we think is a reasonably good, what you could start to call slightly beyond the very short-term cover for a portfolio to allow it time to recover, to allow investors to keep taking income.
So you mentioned some rules on rebalancing there. You said the very strict rules on rebalancing, because I'm sure there's at least, it might be a slim possibility, but there is a possibility where somebody gets to the end of a 2-year cash pot because markets have been sort of depressed for a prolonged period of time. As you say, usually we would expect a pretty significant recovery within 2 years. Historically, that's been the case. But, there's always outliers. Yeah. So what happens if it gets to the point when, the cash is running out, essentially, and we're going to need to draw from the portfolio? How does that work? And is that part of the sort of rebalancing, and or just some mechanics of that would be helpful?
Yeah, no, exactly. That's an important question, and that's one that really stood at the center of a lot of the research that we did around the last step. So, to give an idea of the way we go about that, before I give the answer, I spend a lot of my time programming. The other people in my team spend a lot of time programming, and what we do essentially is build systems that we can use to test these rules. Test these rules through markets that have happened historically, but also test them through ones that were much, much worse than those that we've experienced historically. So that gets a little bit to your point there about, it's very unlikely, but we want to be able to really dive into those periods when, if markets do go down, keep going down for a long period of time, how are we going to act? Those are the things we want to build some structure around. So in short, essentially, by simulating where we think the portfolio would end up if we have those very, bad events. So to give you an idea, we're talking about, only 5% to 10% of the time, depending on how much risk you take, that you'd have eroded that 2 years worth of cash. And in that environment, rather than just say, we just always sell the low risk assets or we just always sell the high risk assets, what we follow is an approach where we try to keep the overall mix of buckets kind of consistent. So that may mean selling a little bit of everything, almost, but importantly, keeping the risk profile of the client consistent and minimizing turnover. So I got a bit middled up there, but I think the idea is that it's not enough just to say, all I'll do is always sell the low risk asset. All I'll do is always sell the high risk asset. What we want to do is make sure that whatever we're doing, we're keeping the risk of the portfolio as consistent as possible. And whatever we're doing, we're minimizing the turnover that we're likely to create in the portfolio.
That makes sense. Because, the logic would say, okay, well, draw from bonds, say, the lowest risk, once the cash has run out, if you absolutely have to draw from a portfolio, but because all things being equal, probably the bond element of a portfolio will have suffered the least, certainly the investment grade or government bonds or whatever. So that kind of makes sense. But of course, by doing that, you do tilt the portfolio a bit, don't you? Because you end up with a higher proportion by percentage of equities then. And so you end up potentially potentially at least getting outside a client's risk profile, a kind of risk level where they might be comfortable. And so what about sort of general rebalancing then? Because again, rebalancing is so counterintuitive, at least on paper. It's like sell the good stuff and buy the stuff which is not performing quite so well. And surely you don't really want to be messing around with that, particularly if markets are really suffering, do you? You don't want to be doing unnecessary trades. So it's I can imagine it's quite a balancing act.
Oh no! Well, there you go. No, it absolutely is, and that's what I got. That's when it got to kind of when I was talking about the bucketing approach earlier. People. The biggest criticism that always comes up against this idea of bucketing is that in doing that you create cash drag. You can now tell them that's not true because you don't have to if you balance it out with some high risk assets elsewhere. But importantly, when you do that, you can imagine as you're reducing the amount of cash in that portfolio through time, you are potentially moving the risk profile. Now, what we found in the way that when we were doing this testing is that you have some natural rebalancing that takes place as well. So because you have this high risk pot, when markets are down, that's going to fall by more. So you'll have less cash, but you have less in your riskiest investments as well. So that balance, the thing that you're using to balance has fallen, so the portfolio can end up being relatively stable. But I think the main point that we wanted to achieve with setting out in bucketing is matching the risk profile, but also making sure that we're matching that through time. Yes, you could sell bonds, but what happens if markets go down for 3 years? Then you're going to sell a whole year worth of bonds. What happens if they go down for 4 years? And these things sound very unlikely, but you only have to look to examples like Japan. Yeah, sure. And you can see that can happen for a very long period of time. What we wanted to do is set up a process where we knew, with a degree of confidence, having tested through markets that are much, much worse in history, that whatever we were doing was going to continue to provide income, but keep that client consistent with their risk profile. The worst thing I'd want to ever do is set out on a journey where saying, look, if markets go down for 5 years, which is very, very unlikely, but imagine that they just went down ever so slightly for 5 years, just continuing to sell down bonds and then leaving this portfolio more exposed to a significant drawdown. That's what we wanted to avoid against. So the rules that we've set up essentially mean that, after 2 years, we rebalance to a portfolio that minimizes turnover but keeps that client consistent with the risk profile, and then we just keep rebalancing back to that portfolio every 6 months after that point. There's this idea of crystallizing losses and sequencing risk, people call it, or pound cost ravaging, the opposite of averaging in through time. Now it's impossible to eliminate those risks.
Exactly right. Yeah, agreed.
It's impossible unless you just hold cash, but what we can do is manage them. And what we can do is manage them in a way that also stays true to the risk profile, because those are almost the two competing things we want to do. Keep the same amount of risk in the portfolio and also minimize crystallizing losses and also provide that income through time. So I think our rules, not having those defaults of selling automatically a single type of asset, allows us to achieve that through the testing that we've done. And that should, we think, over the long run, keep clients comfortable. I think one of the benefits of having this sort of approach is, and I like saying this internally and also externally, I can tell you how every single client in the retirement income service in Seven was rebalanced through March this year. If you told me what markets did over the next 5 years, I could tell you exactly how they'd be rebalanced. And those rules have been tested through, significant down markets. And we think that is comfortable. That's the sort of comfort that clients, we think, want, that people investing for their retirement will want to be able to. They'll want to be able to know.
Definitely, yeah. I'm sure it's perhaps it's not true for everybody, but for me, I think this should be more science than art. I think there should be quant behind it, and obviously the world is a chaotic place sometimes, but I think it should definitely be backed up by research and testing and all that sort of stuff, so it's very encouraging. I imagine, Matthew, that some people come to you, perhaps people have been invested with 7IM for years, and they've got pension pots and they've got ISA pots and maybe they've got GIA. How on earth do you go about balancing, where to draw from? Or is that the financial planner's job? Which wrapper to draw from, I mean?
Yeah, no. So I think that is partly the financial planner's job. I suppose there are, basic rules that, people would tend to follow about kind of which of those pots to draw down first. In terms of leaving pensions and leaving ISAs and drawing from GIA first, given some tax implications. But I think one of the beauties of the bucketing based approaches is that because assets are already being split up, it works very well that we're splitting up across different tax wrappers as well. So splitting across those tax wrappers works as a default, if you like, and we could just take it, the instructions from the client or advisors on the order in which they'd like to take that down. But there tends to just be some sensible defaults that we follow.
So we live in a world now, with infinite information, thanks to the internet, and people, I think more than ever before, engaged with their finances. Not everybody, obviously, but many people are. I just wondered how possible, how easy you think it might be for people to set something up like this themselves, given we've got D2C platforms, we've got very low cost investment approaches, offered by many fund houses, not only sort of practically and technically to set up like the various buckets or whatever, but also how to deal with the emotional implications of running this sort of thing themselves.
Yeah, so I think it would be difficult. I think if we think about the steps of what we've put together, essentially the model that guides how likely things are to be successful comes from an independent model that we've built internally for dealing with some of the DB schemes that we work with. Sure. It's been independently audited by kind of actuaries. So, there's a lot of knowledge, I suppose, inside of that. A lot of the knowledge that's inside of that is simply coming up with kind of long run expected returns for portfolios as well. That's a really important input, as you can imagine. And so, sitting on top of, best part of £10 billion worth of assets internally, that's obviously a big question that we put a lot of resource into answering through time. Then when it comes to how to split the buckets up and know how to essentially do that balancing act that I talked about just now, that again, it makes use of some internal models that we built, some proprietary models, and based on the volatility of these things. So that can be a really difficult task. Yeah, sure. I think when people talk about bucketing, there's this idea that they can get it. They can see how people would feel more comfortable following that approach. They can see how it makes sense. The biggest issue is running it. It's running it through time, is knowing how to do that balancing act, is knowing how to set what those rules should be, is knowing that, for the way that we've constructed it, 2 years of cash makes sense rather than 3 or 4 or 5. But, there's so many questions that I think layer up at multiple steps. And so I think it becomes, for us, something that we didn't invent, just as a new product to market when, as you said at the start, everybody's suddenly hunting for these thing called centralized retirement propositions. For us, it sits on 5-10 years worth of research and 5-10 years worth of work into expected returns. It's just now, I think, with pension freedom, this wave of money, baby boomers, etc., that we thought, hey, we should be offering this to people externally, allow people access to this research that we've done, essentially.
Fantastic. It's fascinating. It's such a hot topic right now, and I am sure that folks listening to this and watching it will enjoy understanding the depth of mechanics and the research and the thought and the stuff that goes into it. So, look, where can people find out more about 7IM and the Retirement Income Service?
So if you just go on the web, 7im.co.uk, you can just follow the links from there. If it's either on the intermediary side, if you're an advisor yourself, then there's the intermediary section, or private. If you're a direct client, then the private client section. And through there should be links that are going to take you to either the Retirement Income Service specifically, or I'm thinking about retirement. And from there, there'll be links or documents that people can go to where we can really kind of bring it to life even more.
Well, I'll make sure all that is linked on the page here of the podcast on the YouTube channel. Matthew, I always like to take the opportunity whenever I have somebody from 7IM on, which is infrequently because you guys don't ask for very much airtime given the support you give me over the years. So I just wanted to say from Meaningful Money, from the community behind me, just thanks for nearly 10 years of support from 7IM. It's been an absolute godsend. Could not have built Meaningful Money to what it is without the help of you guys. So I just wanted to say thank you so much.
No, and thanks for the time and the conversations today. These are really interesting conversations, if not now, more than ever. And working with businesses like yourselves has been a great part of we've grown at the same time as you've grown.
Exactly, it's been a great partnership. Matthew, thanks. Have a great rest of the day.
Brilliant, thanks.
So there you go. Hope you enjoyed that. Hope it was helpful. Obviously, there's a great deal goes into building a retirement portfolio. I'm sure you gather that from the conversation with Matthew. I remain convinced that the raw mechanics of it are possible for anybody to achieve. Of course, when you're an investment manager, it's easier to apply cold logic to the decisions that need to be made. Less easy, of course, when it's your own money. And it's that disciplined behavior, I think, that is the biggest challenge, particularly for solo investors. Food for thought, I'm sure. Any questions, you know what to do. Go to meaningfulmoney.tv/RP4. Leave your questions and comments there. Okay, here's a review from Little Country Toaster, who says, crucial. That's something Lenny Henry used to say back in the 80s. Crucial. I've been struggling for ages with money, and it wasn't until I found Pete's podcast when I realized how simple it is in general. If you're not into finance, and if you don't understand it intuitively, it's the best podcast ever. All episodes are exactly my cup of tea. Easy to understand, even for a foreigner. Effective, no fuss and terminology, and only the important bits. Please keep up the good work, and don't stop doing what you do. You're reaching and helping a lot of people. Thank you. Well, thank you very much. What's it? Country Toaster? Little Country Toaster. Thank you so much for leaving that review. If you want to leave a review, please do so. It really helps me keep at the top of the rankings, helps others to hear about the show and to subscribe. meaningfulmoney.tv/iTunes. If you happen to be listening on Apple Podcasts, easily the biggest podcast network of them all, but wherever you're listening, if there is an opportunity to leave a review, please do. Really, really helps me out. Okay, in the next few weeks, probably in late June, though we've got quite a lot to do before then, we're going to be doing a founder's launch of the third and final phase of Meaningful Academy, and that phase is called Retirement Planning, just like this season. It's almost like that was worked out. So if you want to be kept informed when the launch is, then head over to meaningfulacademy.com, click to find out more about retirement planning. Okay, it's one of the options there. Just find out more, add your name and email address to the form there, and we'll keep you posted. Right, next time we're going to be talking about risks specific to those in retirement. Lots of important things to address next week, so stay tuned for that. That's it, though, for this week's Meaningful Money podcast. Hope you enjoyed it. Hope it was helpful. Any questions or comments, meaningfulmoney.tv/RP4. Or if you're not in the Facebook group, definitely join that, meaningfulmoney.tv/community. It's a great place to ask questions and get them answered. Hope you enjoyed it, folks. Thank you so much for listening. I'll talk to you next week. Cheers.